Hi friends, my name is Krishna. Welcome back to my YouTube channel. Today's topic is going to be on days receivables. In my previous video, we already spoke about days payable outstanding, right? Now we are going to talk about days receivables. What do you mean by days receivables? Days receivable means how much time or days a company takes to convert their receivables to cash. What do you mean by receivables? Receivables is nothing but amount business is supposed to collect from the debtors. Receivables is nothing but the amount to be collected by the business from debtors, from their debtors, right? So, how fast business unit is able to collect the receivables, collect the amount from the debtors is something this days receivables will talk about. Let us say I have given 30 days credit or 60 days credit, 90 days credit to my customers. Are they paying within 30 days? Are they paying this amount, their outstanding amount in 60 days? Are they paying their outstanding amount in 90 days? That is something every business unit would like to know, right? So, how do we know how much time business unit is taking to collect the amount from the debtors? So, here there could be a confusion. Krishna, what is the difference between days receivables versus days sales outstanding? Please don't get confused between days receivables versus days sales outstanding. Days sales outstanding talks about from the date of sale, how many days it is taking time for business to collect the revenue. That is what days sales outstanding says. But days receivable says what is the collection capacity from the credit period given to the suppliers, to the customers. For example, 30 days credit I have given to the customer. Business unit has given 30 days credit to the customer. Is that customer able to pay that amount within 30 days? Is he taking 60 days to pay? Or is he taking 90 days to pay? His credit limit is 30. He has to pay on 30th day, before 30 days. If he is taking 50 days, that means what? He is taking 20 days additional time to pay that amount. Somebody got credit facility of 60 days, but he is paying at 90 days. That means what? He is taking additional 30 days to collect. That means overall he is taking 90 days to make the payment. So what days receivable says is from the day he is supposed to pay, how many days it is he is taking to pay that amount to the company, right? So days receivable talks about the days company takes to convert their receivables into cash. Clear? Now, how do we calculate this? Simple, very simple steps. Step 1, accounts receivable turnover ratio we need to calculate first. How do we calculate? That I will tell you. Second, once we calculate the accounts receivable turnover ratio, what you just need to do is 365 divided by your accounts receivable turnover ratio is equal to your days receivable. Simple. Now, let us talk about how do we calculate accounts receivable turnover ratio. Accounts receivable turnover ratio can be calculated with this formula. What is that? Net credit sales divided by average accounts receivables. Net credit sales divided by average accounts receivable. This is the formula. How do you get net credit sales? What do you mean by net credit sales? First of all, suppose let us say credit sales are $80,000. The sales, whatever goods you sold, there could be some goods returned to our organization, right? So you need to take net of credit sales. What do you mean by net of credit sales? Credit sales minus returns. Let us say $10,000 worth of goods got returned. So what is your net sales? 70,000. Actual sales 80,000. 10,000 worth of goods returned. So net sales is 70,000. So you need to take 70,000. This is what is net credit sales. Right? So you know the net credit sales. Divided by average accounts receivable. Average accounts receivable means opening balance of the accounts receivable plus closing balance of the accounts receivable added and divided by 2, you get average accounts receivable. Let us say beginning of the year you have 10,000 accounts receivable. End of the year you have 20,000 accounts receivable. So that means what? If you add these to 30,000 divided by 2, that means your average accounts receivable is 15,000. This is how you need to calculate average accounts receivable. Then once you get this information, once you arrive what should be your net credit sales and what should be your average accounts receivable, apply the formula. Net credit sales divided by average accounts receivable is equal to your accounts receivable turnover ratio. As simple as that. So let us take this as an example. Let us take an example and start working on that. Okay. Let us say credit sales $1 lakh. Right? Then we have returns, sales returns 20,000. What is my net credit sales? $80,000. This is my net credit sales. Right? Then next information. What is your opening AR balance? Accounts receivable balance opening. How much? It is $35,000. Opening accounts receivable, that means beginning of the year, what is your accounts receivable? That is $35,000. Closing accounts receivable, how much? Let us say it is $45,000. End of the year, what is your accounts receivable? Accounts receivable balance is nothing but your debtors balance, outstanding debtors, right? So how much it is? 80,000. If you add these two, divided by 2 is equal to 40,000. Right? Now, accounts receivable turnover ratio, accounts ART, accounts receivable turnover ratio, just I put the abbreviation here. 80,000 divided by 40,000 is equal to 2. So what is your accounts receivable turnover ratio? 2. Simple. Right? Now we will go and calculate accounts receivable. How do you get accounts receivable? Accounts receivable, days receivables is equal to 365 divided by accounts receivable turnover ratio. 365 divided by accounts receivable turnover ratio is what? 2 divided by 2 is equal to 180 2 ones are 2 16 182.4 approximately, right? So 192 days approximately, right? So it is taking, business is taking 192 days for collecting the debtors amount, accounts receivable. The credit period can be 30 days, 40 days, 50 days, 90 days, anything. But how much time business unit is taking to collect their accounts receivable? It is 182 days. Then once you arrive this days receivable, what you need to do is you need to compare this with your industry again. How other companies in the same industry is able to collect this amount from the debtors, from the receivables. Are they able to collect the amount within 100 days or within 50 days? Then they are doing good. That means you need to improve. Your collection department need to work a lot in terms of calling them and getting the amounts being collected. So how do you perceive this 182 days? You need to perceive in such a way that how is the industry standard? Where do I stand? What is that I can do to improve myself to collect the amount from the debtors. That is how you need to calculate, and that is how this days receivable is going to help the business unit, right? I hope the content is clear, right? I'm going to explain days sales outstanding in a separate video, right? Right now, let us conclude with the days receivables, how days receivables is going to help the organization. This is how the days receivables calculation can be done, and I hope the content is clear. If you like the content, please like my video, share this video with your friends and colleagues, and subscribe to my channel as well. Thank you so much.